It very much is a direct correlation. We've been at this a long time, and my staff, really, they're partners. They make me look far better than I really am. But we sit down just in a group format and discuss ideas, and some of the research was provided by our interns at Texas Lutheran, and a lot of it we did ourselves. But it's to come up with companies like, Tesco, which is one of Warren Buffett's, holdings right now, to sit there and look at why is it down? Why would Warren Buffett like a company like that? To figure out, okay, here's a company trading for 8 times earnings, but it's got better than a 5% dividend yield. And yet, when you look at it, it's trading for well less than tangible book value and probably trading for less than just the value of its real estate. So you're almost getting the business, the operating business, for free. That's the kind of thing that when we sit down, that light goes off in your head and you just say, this is real, this makes sense. I can understand Tesco. We understand Walmart in the States. The Tesco model is very similar, and in some ways I think it's actually better. And so when you look at our portfolios, you see a lot of names like Johnson & Johnson or Budweiser, Philip Morris, things like that that are, in our opinion, very simple to understand, but the fundamentals are very good. And this was a good old Texas kind of a saying. When I first got in the investment business, there was this old man, he was 80 years old, he was still working. And he knew I was going to go up to New York for training, and he goes, oh, you get some of that fancy book learning. And I said, yes, sir. And he goes, look, I'm going to tell you everything you need to know in one sentence. And I thought he was just kind of pulling my leg. And he goes, eat them, drink them, smoke them, go to the doctor, and look good when you get there. And I just stopped, and I chuckled, and I said, come again? And he said, all right, follow me, Sonny. He goes, eat them, your food companies, drink them, your beverage companies, soda water, milk, juice, hard alcohol, eat them, drink them, smoke them, cigarette, tobacco companies, go to the doctor, your healthcare companies, and look good when you get there. And he goes, your wife will allow the house to be repossessed before she will go out into public without her hair being done. And it was funny, so that was the early 1990s. 20 years later now, that philosophy allows you to take advantage of markets, but also not to blow clients up. And so in 2008 and 2009, really tough times. A lot of our clients were very panicky. Again, we don't manage a portfolio, one portfolio. We manage portfolios for individual clients. A lot of people very nervous. But because of the fundamental research we did, we knew that Walmart was not going to go out of business. They might be strained, but when you looked at the actual money they were making more money each and every day. Budweiser was selling more beer worldwide every day. Philip Morris was selling more cigarettes every day. And as a result, it allowed us the opportunity to actually show our clients what was going on with the actual businesses. Turn off the news, turn off Wall Street, and say, if you owned 100% of this business, much like Buffett does, would you be satisfied with the results? And the answer is pretty much yes. And so, again, Johnson & Johnson, Colgate-Palmolive, Procter & Gamble's been in our portfolios in the past. It's a lot of very simple to understand type things. And then we'll do some other things to enhance the value of that, generate a little bit more income. Way back in probably the early 80s, Buffett wrote put contracts that generated a good size amount of income for him. And it allowed him to set a price on Coca-Cola that he was willing to say, I will enter into this contract. If Coke dips, I'll buy it at this price. And somebody else has to pay me for the privilege of selling it to me at that price. So the first contract Buffett wrote, it expired worthless, and he just got to keep the premium. The second one he wrote, it exercised, and he ended up with a ton of Coca-Cola, which is very legendary for now. We implement that strategy on a regular basis. We're big fans of writing puts to generate additional cash flow into the portfolios. If we have done our homework, we should be able to sit there and identify what is a fair price or a price that we would be happy owning a given business. And if we're able to do that, and then we can enter into a put contract, there's been many, many times to where we've written put contracts just month after month after month, somewhere 7, 8, 9 months down the road. Finally, the market drops, it triggers, and we end up with a lot of option premium as well as a company we wanted to own in the first place. Now, obviously that involves some risk. To offset that risk, we always have the cash sitting off on the side. And so some of our clients always want to know why we have so much cash, but it's always because we know we have this outstanding obligation.